and we'll just get the webinar rolling. I think people will keep rolling in, but Dan, just make sure we're recording here. So yeah, welcome everyone. Really excited to present this webinar and bring this really, I think, one of the most unique and compelling opportunities we've put together yet. And we'll just get started quickly with an intro, team intro, investment summary. We'll have Travis, my partner, lead most of the sections. We'll have Phil, our other partner, on the construction and property management side, go over the renovation schedule and budget. But just quick background on ourselves. So we're a vertically integrated sponsor operating in a couple markets. Our primary market is Colorado. We've been investing for about 10 years. And in Colorado, we're partnered with 3Gen on the property management and construction side. As we have a brokerage arm as well. And then our other partner here is Travis and Offered, who this will be our third deal together. Offered specializes in off-market acquisitions, and we really we've have a 2-year plus campaign and sourcing operation running with them, and we've been able to really bring some significant value add and compelling deals to market. So again, on the Cross Mountain side, we have about 1,000 units between New England and Colorado, counting our affiliate property manager. Our primary focus again now is on the Front Range in Colorado, in particular Colorado Springs and Pueblo as well. And I'll turn it over to my partner Phil, who will go over kind of the on-the-ground operations we have going there right now.
Thanks, Mike. Pleasure to meet everybody here. My name is Phil Lose. I'm the head of 3Gen. Stands for our 3 generations. So I brought my dad in during COVID. He was retired and twiddling his thumbs and had a whole lot left in the tank. Brought him out to help build this out. He's now in charge of our fire maintenance division. And our 3rd gen is my son, Mason, who's in, I think, algebra class right now. He's 17, getting ready to graduate, waiting on his football game tonight. And, excuse me. And so that's our team in the 3Gen. We currently manage over 30 properties on the Front Range, over 1,000 doors, and over $150 million of assets under management. And we're north of Denver, the suburbs north of Denver, all the way down to Pueblo. As Mike was saying, we are also a vertically integrated firm. We have a brokerage arm. We have a construction division that does tens of millions of dollars a year in multifamily construction. And then we have a property management arm that we just discussed as well. I've been in the business for the better part of 30 years now and have done everything from single family all the way up to these big multifamily projects. With that, we'll let Travis tell us a little about himself.
Yeah, thanks, Phil. Hi, everyone. I'm Travis Reese. I'm the CEO and founder of Offered, based here in Austin, Texas. That's how I get away with the long hair and the mustache. Yeah, I think as Mike mentioned earlier, this is our 3rd deal together. And I run an acquisitions firm that specializes in off-market sourcing. And this portfolio is an example of that. And I think one of the best, investments that we brought today. And so when I just look at the team here and the partnership, we kind of have all the boxes checked. We have Mike, a strong operating sponsor. We have Phil on the, the property management side. He's executed on 2 of our assets, and then us on the acquisition side. You also have Gunnar Telto, our president of investments. Gunnar, if you want to say hello. And Eugene, which is the head of asset management underwriting. Yeah, with that, let's get the party started.
Let's dig in.
Great. So we have, this deal here required about $9.7 million worth of equity. We have about 2 million left to raise at the moment, and that's what this webinar is really about. We're looking for commitments by September 29th. And these are soft commitments. We have a scheduled close November 2022. So we have about 45 days or so left to close this asset. We have our debt firmed up, which we just got approval last week. We have a strong lead sponsor on the equity side, Fairway America. I believe they're on the call as well, and are really looking to reserve, and continuing the last sort of couple of deals that we've done, an allocation for our individuals and for our syndicates. So, this deal here is a heavy value add asset, similar to the deals that we've done in Denver, similar to the deals that Phil's managed in Colorado Springs. And so we're looking to hold this for about 2 to 3 years. Realistically putting in a time horizon of 5 years there, all things being said. But the nexus of this asset is that we're getting it at a below market price with significant value add in an excellent submarket, Colorado Springs. And we'll talk a little bit about that. So what does that mean? I think this is the strongest asset in terms of returns to LPs that we've seen and that we've brought to market, generating about a 26% internal rate of return over a 3-year period, which is about a 2x over 3 years. And the promote structure being very healthy with an 8% preferred return to individual investors. If we zoom out and want to take a look at the capital stack there, it's comprised of a $31.1 million senior loan. Digging into that a little bit, everyone's aware of the current market and inflation and rates climbing. We were able to secure a fixed rate loan today, which pencils at about 5.75% fixed over the life of the project. That may seem like expensive if we're looking back 2 years ago, but in today's environment where we have more commercial debt in the 8 and the 9%, we feel really, really good. And the fact that it's fixed also reduces the risk profile of the asset. On top of that, we have about a $6 to $7 million preferred equity tranche. And that preferred equity in the current model has been underwritten pretty aggressively and is continuing to get better and better and better. That preferred equity gets a preferred return, and that preferred return is capped. And so that means that the remaining equity there, the 10.4, which is comprised of Fairway, which is bringing $7 million to the deal, and our equity raise here between 2 to 3 from individuals, means that a large chunk of the returns accrue to common equity investors. Next slide, please. The portfolio overview, it's comprised of 5 assets. The total purchase price is $40 million, 293 units, all within the Colorado Springs market, probably within a 2-mile radius of one another. In fact, Phil's sitting in one of the assets at the moment. And I think that's another point I want to make at the outset, which is that, given the portfolio and given the current state of operations, 3Gen and ourselves have been able, through our purchase contract, take over management earlier. So we already have a head start on the reposition. In fact, Phil has already signed leases today, which are $300 more than the current rents that they're getting at these assets. So we already have a great head start on this particular portfolio. Phil, as you mentioned, lives in Colorado Springs, has repositioned a number of assets, has over 1,000 doors under management, and knows the market inside and out. So we are getting this at $136,000 a door, which comparable properties, and we'll take a look at that at the end, over the last 18 months are trading more for like $170,000 a door. This is a value add strategy, a 2 to 5 year hold. Realistically, we're looking to exit this in 3 years. I mentioned the preferred return. And, given that we are with our renovation and pushing rents just through our operations, getting in between $400 and $600 rental bumps, ending up in still that affordable range for the demographic and the income that we have in the immediate submarket. Next slide, please. So for investors in your shoes, what does that look like? For a $100,000 investment, that looks, again, like a 2x return over 3 years, just about. The waterfall is shown in here. Again, a preferred return up to 8%, after which the sponsor starts to participate. After an 8, and then after 14, and then after an 18. Next, please. Some of the highlights that I've already touched on. One, this being an off-market transaction. Off-market is something that can be advantageous. I think in this particular scenario, it's been a benefit. It's allowed us to work directly with the seller to come up with a solution to get this portfolio closed. The business plan here is really forced appreciation, right? So the bones of the asset, the exterior, and there's been a significant amount of CapEx spent by the current ownership group, has already been done. So the majority of our CapEx will be spent on the interiors, which have largely been, neglected. I'd say about 100% of those interiors are what we would call classic. And so we're going to take those units to where we've taken them in the 2 Denver deals that we've done together with Cross Mountain, to where Phil's taken his assets down in Colorado Springs, and really take this from a C- to a solid B asset. We're also benefiting from, exceptional market rate growth. Colorado Springs being one of those top markets that have experienced an influx of population. Population drives fundamentals in housing and multifamily. And that is a tailwind that we have here in Colorado Springs. Of course, being an inflationary environment, real estate also tends to perform well. And so we expect on a move forward basis, that rents will continue to organically appreciate on top of the forced appreciation that we have. I think we've underwritten this deal conservatively based on our experience. Just a point that I like to make: the 2 deals that we've done with Mike, we are both of those assets. We are ahead of our pro forma, ahead of the rents that we initially modeled. And given that we are currently managing this asset and accomplishing $200-300 rental bumps just through operational efficiencies and excellence, we feel strong in that category. Next, please. The market overview. Again, I think everyone on this call probably knows where Colorado Springs is. That and the Denver market are the top 2 markets, I would say, in the Colorado market. I think there's numerous different statistics that we can point to that identify Colorado Springs as a solid submarket that is attracting workers and a populace that have good jobs. And so, as well as the fact that we're bringing these rents to a level that is still affordable, still in that $1,200 to $1,300, $1,400 range, which in today's environment, sitting here in Austin, Texas, and other markets, and us having exposure on the offered side nationally, are still very affordable. Next, please. I'll hand it over to Phil here to talk a little bit about the assets, being that there are 5 here. And so, Phil, take it away.
Thanks, Travis. And like you said, I am literally in, I think it's the 3rd slide down, the Aspen Creek apartments as we speak, as we've taken over management of these. It's 5 individual properties from one end to the other end. It's about probably a 12-minute drive, so they're all very close to town, kind of around the outside edge of downtown. We're grouping this together. We're calling it the Olympic Apartment Group. And then we have one logo, and then each property gets a separate name. So Arroyo Apartments is going to become the Olympic Court Apartments. The Arroyo Apartments, currently it's 62 units, 1 building, 3 floors with a garden level. This one does have solar panels being installed as we speak. Ample parking, which is something that we don't find a lot down here. Exterior breezeways, all new windows. Our rehab plan for this one is we're shooting for an exterior revamp, freshen up. The big lift on the outside is we're going to bring the pool back online, put in a barbecue and a dog area and a little courtyard in this middle section where the pool is, and really brighten it up. And then obviously full unit rehabs on all 293 units across the board. But it's in a very nice location, very close. You can get downtown in less than 10 minutes. There's shopping, restaurants, and the 3rd floor apartments in front of the pool have a magnificent view of Pikes Peak. So that's the Arroyo Apartments. The next apartments that we have up are going to be the Sonoma Heights Apartments, which our post-renovation rebrand is going to be the Olympic Gardens. Again, this is another 60-unit building complex, This one has 2 buildings with 3 floors, interior hallways, in which they have storage closets for each unit in the hallway. All new windows, solar panels literally just got finished up last week. And new windows. And this one, again, tons of parking. Something on the property management side we never see. This one's a pretty straightforward rehab. There's not a ton of areas to do landscape in the front of both buildings. And so we're going to do up the landscape really, really nice. Unit rehabs, interior hallway rehabs. One of the exciting things here is we have new construction across the street going in. We have a bunch of complexes in and around within blocks that are being bought and rehabbed. So the whole area is a rising ship for around Sonoma Heights. And again, that one's probably about a 3-minute drive from Arroyo. Next one up we have here is the Meadows Point Apartments. This one is very close to downtown, very close to freeway access. We've got 2 buildings here, 3 floors with, again, a garden level, 77 units total. Solar panels are set to go in here next week. They've got everything done. They were sitting on a container for 3 weeks. All new windows again installed on this entire property. Interior hallways are being redone as well. Unit rehabs the same as all the others. And then a big rework on the outside, freshen up the paint scheme, looking a lot less dated. And we're going to rework the parking lot. This is the one parking lot that doesn't work very well to give us adequate parking and a fully functioning parking lot. The next one we have up is Aspen Creek. That's where I am, all the way in the back there. This one's 2 buildings, 2 floors, has a newer roof. This is the one property that is not getting solar. It just didn't have the proper coverage to support the load it was going to need to be able to be justifiable. This is also our easiest rehab. It's pretty straightforward. Interiors are all the same, getting full rehab. Exteriors, just a big freshen up. There's a little area in front of the office here that will be used as a barbecue picnic area. Real light landscaping, which is nice from the management side. And this is also where the office for all 5 apartment complexes will be located. We have 1 unit here that we can't use as a unit, so it was the best place to put the office for the whole portfolio. And the last property we have to talk about is the most exciting one, and that's the Midtown Flats. Midtown Flats is 60 units, 2 buildings, 3 floors with a garden level as well. Has a fairly new roof, brand new solar panels already installed. Again, great parking, and it actually is gated in the front, so we can control access to the parking lot. Again, all new windows, all new sliding glass doors have been put in. The outside really just needs a refresh of all the colors, making all that nice, fixing up a few things. You can see in between the 2 buildings, we're going to make a little courtyard area in there, the grilling area, dog stations, some real nice landscaping. Currently, these units are 100% vacant. There are no units, and they are pretty much down to just sheetrock. The old ownership group had a very grandiose plan that they were not able to execute. So they've actually done some of the heavy lifting for us. They've demoed, they've cleaned them all out. The abatement's already been done and signed off by the state, and we already have all the materials on site to do 60 bathrooms ready to go. So we plan to attack this property really hard and fast, take 1 building at a time, try to get it done in about 30 to 45 days, turn all the units, rent one side while we do the other one, and turn this into 100% of the new rent producing asset very, very short order. And that is the properties in a nutshell.
Yeah, thanks, Phil. So digging a little bit more into the business plan, how we make money and how we intend to operate this asset. So one, again, it's forced appreciation through income enhancement. These properties are we're gonna invest roughly over about $4 to $5 million of CapEx, predominantly focused on the interiors. As Phil just mentioned there, Midtown Flats being a vacant asset, vacant can, sound negative, but in this particular scenario, it's a positive in that we will be able to day one hit the ground and turn and renovate with volume and mass the entire building and get that leased up, hitting our pro forma rents. The plan from there is likely to sell Midtown Flats and any remaining preferred equity to be paid down. From there, we begin distributions. The Midtown flat sale, hopefully happening within the first 12 to 18 months. Given that, I've seen Phil firsthand. He was our contract administrator on Ingles Grove, which is now Sloan's Lake West, execute on that program ahead of schedule and on budget. I feel pretty strong that he can knock it out here in his hometown quicker than that. And then from there, and simultaneously working on the rehab of all the other assets and ultimately exiting in year 3. Next. I'll hand it over to Phil here to talk about some of the other operational efficiencies and cost savings that we also plan to implement.
And some of that, we're obviously raising rent to bring the income, but we're also working on reducing our cost load. The properties, to say they are being operated inefficient would be a understatement of proportion. So one of the things we're going to be doing is we're going to work on our energy plan. We're going to be installing low flow toilets, low flow faucets, smart tech for looking for leaks, smart tech for our thermostats, upgrading boilers, LED lighting, anything we can to drive down the utility cost. And then when you add in the fact that we have paid for solar panels, not leased, but they're actually paid for and owned, we should be able to reduce our energy costs by about 50%. At the same time, we're actually still, able to recoup money for utilities along the way. So the energy savings is a big one on this one because they are operating extremely efficient. There's probably on inspection 60% of faucets that were leaking. Even if we just fixed them, we would increase that quite a bit. Our unit renovation plan is very similar to what we've been doing across the entire Front Range. We're using LVP floorings, quartz countertops, shaker cabinets, higher end fixtures, two-tone paints, newer carpets. And because we're buying in bulk, we're buying in volume, and we've partnered up with a lot of local vendors, we're able to get these at a cost that is similar to a lower quality product. So we're putting out a higher quality product at that lower cost that helps drive the rents that we're achieving on the next page. So as Travis was saying, our currently operating here, their average rents are $660, $700, and $810 when they collect them. We are currently signing leases at $1050 on 1-bedrooms and $1275s on 2. And we've really started to see a pickup in traffic as we've kind of ensconced ourselves in the property, got in and cleaned up exteriors, cleaned up hallways, made them show better. So that the projected rent that we're shooting for post renovation is very conservative compared to what we're already getting with these properties not renovated. And it's also very conservative to what we're seeing in the market across the board, especially on the 2-bedroom side, which we have a pretty good mix of in this one. The 2 bedrooms are running strong and high right now throughout the Springs. And just to touch on the Springs and its location a little bit and why it's such a strong market for us, Denver is a strong established market up north that has gotten to be quite expensive, which drove them down to us in the Springs. And then the Springs started coming up, and it's got an outlet down in Pueblo, which is coming up in rents. So what we're getting is just higher and higher quality tenants that are willing and able to pay more for a quality product. And that's what we're seeing across the board. We have 2 bedrooms in close proximity to these that are getting over $1,650 a month in rent for similar stock. This is one of our case studies. It is about a block and a half from where I sit today. We did this one full cycle with one of our other investors. He purchased a property for $1.4 million back in May of 21. It's scheduled to close in, I believe it's 10 days from now. We got extended. And at a rate of 2.2, we got 200 at the door. He purchased for 137. What we had put into these was about $8,000 a unit, and that was about it. I think we spent $10,000 on the exterior of this one. We pushed rents on these in the neighborhood of $1,100 to $1,250 between the 1s and the 2s. These were pretty small units with kind of weird layouts. Our model going in was for 950 and 1150. So we ended up getting quite a big jump on those. The second one that Travis was alluding to before is the Ingalls Grove, which we turned into Sloan's Lake West. We came in about 6 months ahead of schedule on the rehab. We started out with rents of an 1180 projected, and we're renewing and renting the couple vacants that we have had pop up for $1,400 and $1,700, and they were gone pretty quick. Deal level IRR at plus 50%, next month as we execute our exit strategy on that one. These fit and finishes of those units and these units here in our current project is similar to what we're shooting for on this project as well. And this is our current reposition in Denver, which was the Edgewood Apartments that we rebranded as the Atrium. This was also a very heavy value add lift and a very heavy management lift. We inherited what they told us was 35, turned out to be a little over 40 because they didn't even know how many they had vacants. We've gotten through all these units. We've got all but 10 rented, over half the complex done, and 85% of our exterior work done in only 6 months at that property. And we've gone from a projection of 1180 to 1350 on the ones, 1420 to 1600 on the twos. And honestly, we feel that's 50 to 75 low. We just inherited a lot of vacants. So in this first tranche, we were aggressively trying to rent them, but we have further rent growth there as well. And then I will let Travis dig into the financials here.
Yeah, thanks, Phil. This is kind of tough to digest on a webinar and on this type of forum here, but I think that when we look at how we're driving value here, it's really driven by the top line and how we are growing that revenue across the holding period. Within the larger deck, there's much more detailed financials, so I won't dig into the specific numbers here. If we want to hop down to the next one, same thing here. We are still, managing expenses. The reason why I also love Colorado is that, unlike here in Texas, where property taxes are quite high, we don't have that in Colorado. And so on a new purchase like this, we're not getting significantly impacted there. But expenses still, managed appropriately. And I would say that quite comfortable with those ratios given, our experience in Denver and our experience with Phil and 3Gen. If we want to look at the returns and the sensitivities related to exit, you can take a look here. We're modeling a 5.5, a little bit over a 5.5 cap exit 3 years from now. I think the market today is, is more like just under a 5. And so we're budgeting for cap rate expansion. You can see there, even at a 6 cap exit in Colorado Springs, which is a super strong market, would still be achieving north of a 20% internal rate of return to individual investors. Next slide. I think we've already covered that in terms of the waterfall. Just being cognizant of time and being in the afternoon here and keeping it tight, we can jump to Q&A.
My favorite part.
And thanks, Travis, for giving that great overview there. The thing I would again highlight is actually our debt. This is some of the best debt we've seen in the market. It's not typical debt from a bridge debt fund. This is full recourse bank debt, which means myself and Travis have personally guaranteed it, which oftentimes sponsors won't do. But we, the spreads are such in today's market that it was incredibly accretive to the deal. So we're really pleased to be able to bring this phenomenal fixed rate debt structure to our investors in today's tough market. And again, the other thing I would stress is the current modeling was done on some pref terms that were very wide. We've since then gotten much tighter pref terms from potential pref equity partners. So as incredible as the returns are looking now, when we run that final model, they're going to go up from here. Before we kick off Q&A, just quick note on the investment process. For those of you who are not familiar, we highly encourage soft commitments before we officially open up the deal with our deal documents for subscription. Typically by that time, the deal is oversubscribed. And to make a soft, again, non-binding reservation, you could do it through the Cross Mountain site, or this is a truncated link here. But it's also accessible through the Cross Mountain site if you create a profile, or if you come in through the deal portal from the email. So with that, we'll get started with questions. So feel free to voice them in the chat or speak up.
Mike, can you hear me?
Yeah.
Jeff Martin in Austin. Thank you for this. I was curious if the waterfalls are European or American in design, collective or individual per property.
Yeah, so it's a net waterfall, so not on a per property basis. Again, there's a accruing preferred return there of 8% that it starts with.
Thank you.
Do we leave them?
This is Hugh Patton. I have a question. Two questions really. One is and sorry if I missed this at the beginning, but why are the seller selling this group of properties is one question. And I also wondered if the sponsors, actually it's a nice fact that you guys are putting yourself on the loan personally, that would give some comfort, but are the sponsors putting capital into this as well? Thank you.
Yeah, sure. So I'll just start with the first one. So the seller essentially found himself with an unwieldy portfolio that he hasn't been able to optimize. He's essentially self-managed it, and it wasn't really a professional operation, I guess, to put it softly. And so things have just gotten away from him, and he's kind of looked around. He has kids, and he's looking around at what he wants to pass on to them, and he's just trying to sell essentially and get into some Class A where you could just clip a coupon. So it's I'd say it's being sold because it's been a headache. He hasn't been able to operate it, and I'd say one of the pain points has been the Midtown Flats, which was the stalled renovation project. So we were able to compel the wholesale portfolio by leveraging that in part, again, at great pricing. And then just getting back to your second question, we, the sponsor, collectively, 3Gen offered Cross Mountain will, through a GP, invest 10% of LP.
Yeah, and to give a little extra color on his pain points and why he wanted to sell, it started with 2 properties that we initially started the contract with. And through talking to him and going through it, come to find out, A, he had more properties, and B, he was just buried and underwater. Their quote unquote management company is derelict, to say the least. They just really don't know what they're doing. And he was very good at acquiring properties, not very good at managing his assets. And so the good news for him is he bought them a long time ago and has forced some appreciation so that he didn't go upside down. But he just really doesn't know what he's doing and has to trade into something different. He's just over his head.
Yeah, thank you.
Mm-hmm.
Don Kane here in Denver. A question, what's the reason for the early sale of the Midtown Flats? What does that do for the deal overall? And second, after that sale, is the plan to keep the other 4 properties intact as a group for the whole hold period?
Yeah,
Yeah,
so,
I can take that one.
okay.
Yeah, so the idea behind selling Midtown Flats is to retire the preferred equity, which, depending upon where we shake out, will be between 12 and 16%. And there's no participation above that. And so we can clear out the majority, hopefully all of the preferred equity. And so we don't have that overhang on the deal any longer. And so the cash flows are stronger now we just have common equity from there. So that's the reason behind the early sale, and cleans up makes it stronger basically for individual LPs and the general partnership. And then, yes, the plan would be to hold the remaining 4 assets and sell as a portfolio in years 2 to 3.
Couple questions in the chat there. Avi was asking, when did he buy it? He's purchased these over a course of time. I think it was roughly in the 2 to 5 year total range over some of these, some a little bit more, but in that general range. And then Emery had a question about the proximity to Fort Carson. So we operate quite a few units here. We really just don't have a lot of people from Fort Carson spread out through town renting stuff. I would guess we're probably in the 5 to 7% range total, maybe, of our portfolio that is military. Fort Carson's a big Army base. It's got a lot of young people out there, and the young people tend to live in the base housing that's a lot cheaper than in town. It helps the business growth of the town because they're going to come into town and spend money and go to the restaurants and the bars and those things. But it doesn't really have an impact on the housing market much. It's very, very much on the margins. So much so that I know we don't, and I don't know of anybody that does military discounts for them. I was in the service too, so I still love them all, but we just no need to give out those military discounts right now. The biggest thing we have is we work with them. It's a little easier to qualify them, and then we're always flexible on lease terms with them with deployments and those type of things. But by and large, most of the military here at Fort Carson stays on base. There's a few other smaller bases, more higher end, more officers. Those people are scattered out a little bit more through town. Technically, we have 5 bases here in town. Fort Carson's really the one that you know about, but Cheyenne Mountain is the coolest one because that's where NORAD is. So, like, if you accidentally come and drive up that way, they will turn you around and shoot you down the mountain.
Understood. Thank you.
Mm-hmm.
Hey, question, guys. Avi here from Connecticut. It sounds like that there's a lot. You're kind of getting it at a lot of vacancies and a lot of and underpriced. What's the kind of overall, let's say, total? I don't know if you want to call it loss to lease or kind of like basically the amount of discount you're getting at when you're talking about physical vacancies and economic vacancies to kind of like that pro forma. Seems like it's more than 50%. Is that an accurate description just from looking at the financial statement quickly?
Counting Midtown, it might be approaching that, but probably not quite that high. If you take Midtown out, I was just looking at it not too long ago. I think there's about 10% vacancy right now. If you're looking at the numbers and wondering what the disconnect was, it was that they weren't enforcing rent collection. We just sent 22 files to the attorney for eviction today. So that's the disconnect on the numbers that we're not seeing, and we're starting to pick that up. When my team came in, did the analysis, and then started posting notices that will enforce rules and like actually make them pay rent, all of a sudden our phone started ringing with everybody wanting to set a payment plan. So a lot of it was just they weren't enforcing the rules and people weren't paying. We also cleared a lot off the deck of some really old legacy people that hadn't paid rent for quarters, not just months. And so we've cleaned a lot of that up off the books and actually rented a couple of those properties already.
Got it. What would be kind of like the in-place pro forma cap rate? Assuming you were to basically have your targeted I don't know what your targeted vacancy if it's 5%, and then kind of at the, market rents pre-renovation. What's that going in cap rate looking like from a project perspective?
Travis, do you have something on that?
Yeah, I mean, I think we'd have to run those numbers, and it wouldn't be that hard. We could certainly get back with you on that,
Do you
but
happen to know off the top of your head?
And Avi, I will tell you from being on the ground here, to say that's a moving target, again, understatement as well. Probably a day-to-day change with the cleanup that we're involved in right now.
Yeah, no, it makes sense. Just looking for like ballpark.
yeah, I'm just doing some numbers here. $1,000 a month per unit, 293 units, 293,000 times, that's a month, times 12. It's 3.5 million on the top line. Our expenses, if you look back at our pro forma, were about, what was it, about 1.7, I think, year one. So if I took that 3.5 times a vacancy, times, let's just say all in economic, 10%, 3.5 times 0.9. Let me just, since you're putting me on the spot here, Avi, 3,150 minus 1.7 is 1,450 of NOI. Is that right?
I can see those little fingers moving over there, Travis.
Oh, sorry. Year one expenses is 1.3. So 3.5 times our times point. Let's just go 0.92. 3.22 minus 1.3 is 1.92 of NOI. This is at recent leases. 1.92 over 40. That's a 4.8 cap.
Gotcha. Okay, thanks. That was good, quick math.
Yeah, just a side note, everybody's giving my team some compliments for everything we do on the execution side here. So I love having Travis as a partner. He just whipped that out like it was nothing.
All right, any other questions? All right, well, if there are no other questions, again, we're going to wrap this up in the next week in terms of the remaining capital stack here. We'll quickly get apportioned and targeting November close. So funding probably sometime in mid-October. And yeah, any questions, please don't hesitate to reach out to any of us. And thanks everyone again for joining.
Appreciate all of your time.
Thank you.
Thank
Thanks,
you,
everyone.
guys.
Take care.